All right, today we're going to tackle a big one, a name you've probably heard of if you're an income-focused investor, the Guggenheim Strategic Opportunities Fund, or just GOF. Now, this is a closed-end fund that's famous for its really high monthly payout. In this explainer, we're going to pull back the curtain using the fund's own reports to see exactly how this thing works, what the real risks are, and, where that money is actually coming from. Let's dive in.
So, why all the buzz around GOF? What's the big deal? Well, for most people, it really just boils down to one thing, and one thing only. That steady, high-yielding monthly check. This is the feature that puts it on the map for so many investors.
And this is the number. This is what gets everyone's attention. A monthly distribution of 18.21 cents per share. I mean, if you're an investor trying to generate regular cash flow, maybe for retirement, a consistent number like this is incredibly appealing. It feels solid, it feels dependable.
But of course, that reliable payout leads to the big question, right? The one we're here to figure out. How on earth do they do it? How does the fund generate enough of a return to support that kind of distribution, month in and month out? Where's the money coming from?
Well, if you look at their official paperwork, the fund's stated objective is to maximize total return. Now, that's a super important phrase. It means they're not just trying to do one thing, they're trying to do two things at once. Generate current income, that's the cash for those monthly payouts, and achieve capital appreciation, which just means growing the value of their investments over time.
And here you can see that total return goal playing out over time. This chart comes right from the fund's report. Now you'll see two key lines here, the market price and something called net asset value, or NAV. We're going to circle back to the huge difference between those two in a little bit, so don't worry. For now, just notice the general trend. The fund has grown over the long term.
Okay, so to really get how they chase that total return, we've got to pop the hood and look at the investment engine inside this thing. It's really built on a two-pronged or two-part strategy.
So the core of the engine is this big, multi-sector portfolio of stuff that generates income. As you can see, it's a mix of corporate bonds, senior floating rate loans, asset-backed securities. Basically, these are all different types of loans made to companies or backed by other assets, and they all kick off regular interest payments. That's the primary income stream for the fund. The second part of the strategy has to do with the stocks they own. They use what's called a covered call strategy to squeeze out some extra cash. The easiest way to think about this is like they're renting out the stocks they own. They collect a fee for it, that's called a premium, and in exchange, they give someone else the option to buy that stock later at a set price. This premium income is designed to boost the distributions they can pay out. So we have the main engine, the bonds, and the rented out stocks. But GOF adds a couple of powerful tools to try and amplify the returns from that engine. Let's just call them the income amplifiers.
The first amplifier is leverage. Now, all this means is they borrow money to invest more. Simple as that. According to their reports, they borrow an amount equal to about 16% of their assets. The goal is pretty straightforward. Earn a higher return on that borrowed cash than what they're paying in interest, and then pocket the difference for investors.
And this table, based on hypotheticals from the fund, just perfectly shows you how leverage is a classic double-edged sword. Look here. If the portfolio goes up 10%, leverage juices that return up to over 12.5% for shareholders. Awesome, right? But, and this is a big but, if the portfolio has a negative 10% return, your loss gets magnified to negative 11%. The takeaway is crystal clear. Leverage can supercharge your gains, but it will absolutely do the same thing to your losses.
The other amplifier is the use of derivatives, complex financial tools like swaps. The fund uses these for a couple of reasons. Either to protect the portfolio from certain risks, which is called hedging, or to try and generate even more returns. It just adds another layer of sophistication and, let's be honest, complexity to the whole thing.
So, we've seen the engine and we've seen the amplifiers, but let's get down to it. When you go to your brokerage account and buy shares of GOF, what are you actually buying and what are you paying for it? This leads us to maybe the most critical and honestly the most misunderstood part of a closed-end fund.
Yeah, we've got to talk about price versus true value. To really get what's going on with GOF, you have to understand three little words: NAV, premiums, and discounts.
And check out this chart because it tells a massive story. That top line, that's the fund's market price, what you actually pay for a share on the stock exchange. The bottom line, that's its net asset value, or NAV, the calculated per-share value of everything the fund actually owns. And I mean, you can't miss it, right? That huge, persistent gap between the two.
So that gap has a name.
When the market price is floating way up above the real value, like we see with GOF, we say the fund is trading at a premium. If it were the other way around, with the price below the value, that would be a discount.
Let's just break this down one more time, because it's so important. The NAV is the cold, hard, calculated value of the portfolio. But the market price, that's just what people are willing to pay for it on any given day, based on pure supply and demand. And with GOF, the crucial thing to realize is that you are buying and selling at a market price that has consistently been well above the actual underlying value of its assets.
Okay, so now that we understand the engine, the amplifiers, and this whole premium thing, let's go all the way back to the beginning. Back to that attractive monthly payout. What is really in that check?
To answer that, we need to get familiar with a term you'll see a lot with these high-yield funds, return of capital, or ROC. And this is so important to understand. Return of capital is not profit. It's not interest the fund earned. It's the fund literally handing you back a piece of the money you originally invested. That's it. They are just returning your own capital to you.
And boom, here it is. This is the breakdown for GOF's payouts in a recent fiscal year, and this comes straight from their own annual report. Just look at this. Over 2/3, 68.1% of the payout was characterized as return of capital. Less than 1/3 was actual ordinary income generated by the fund's investments. Let that sink in for a second. For every dollar paid out, about 68 cents was just the fund handing investors their own money back. So when we put all of these pieces of the puzzle together, what we start to see is the fundamental trade-off, what an investor in GOF is really signing up for. It's a very clear reward balanced against a set of pretty complex risks.
On one side of the scale, what do you get? You get that high, regular monthly distribution, no doubt, and you get access to a complex portfolio managed by professionals. But on the other side of the scale, what are the risks? Well, you have the underlying NAV volatility that gets amplified by the leverage and derivatives. And critically, you have the risk of paying a significant premium, basically overpaying for assets relative to their actual calculated value.
And you don't even have to take my word for it. The fund says it right in its own prospectus, stating plainly that its shares frequently trade at a premium or discount to net asset value. I mean, that's them telling you directly that the price you pay is not anchored to the fund's underlying value.
And so that brings us right back to where we started, looking at that tempting monthly check. After we've deconstructed how the engine is built, how returns are amplified, and what that payout is really made of, the ultimate question is one every investor has to answer for themselves. Is the undeniable allure of high income worth the price of this complexity?